Welcome to the deep dive. Today we are going, well, deep into how scientific thinking, the kind of rigorous math and physics approach, left the lab and basically staged a takeover of Wall Street. This whole movement created a new kind of elite, the quants. And we really have to start with the person who kind of proved the impossible could be done. James Simons, the founder of Renaissance Technologies. Get this. Simons launched his medallion fund in 1988. Over the next 10 years, it returned, wait for it, 2,478.6%.
Wow.
Yeah. Just to give you some perspective, George Soros's quantum fund, which was like the next best thing, managed 1,710.1% in that same time frame. Medallion has averaged almost 40% per year, and that's after charging fees way higher than anyone else.
That number, 2,478.6%, it almost sounds made up. It's just astronomical.
Right. So is that just like proof of incredible models, or is it something totally different about how they see the market? And here's the kicker. How on earth do they actually do it?
Well, what's really fascinating and kind of counterintuitive is how Renaissance hires people. They actively avoid people with traditional finance backgrounds. They actually go looking for PhDs, math, statistics, even particle physics.
Oh, seriously? No Wall Street veterans?
Nope. They want people who think in terms of systems, probability, finding patterns. Not someone who's spent 20 years shouting on a trading floor.
So Simons' big advantage wasn't better financial knowledge. It was deliberately not having it. That seems completely backwards.
It really does, doesn't it?
Yeah.
It flies right in the face of, well, decades of assumed expertise. See, conventional finance theory, it always kind of assumed markets were mostly efficient, that consistently predicting the unpredictable, especially long-term, just shouldn't really be possible. Renaissance basically treated the market like an engineering problem they could solve, not like some mystery only economists understood.
Okay, so that's our mission today. We're tracing where that engineering mindset came from, starting way, way before Wall Street and going all the way up to modern chaos theory. Right. Let's get into the real building blocks here, starting with something like derivatives contracts based on something else, right? You might think that's a super modern, complicated thing, but our sources show we need to rewind like 4,000 years. Ancient Mesopotamia.
Yeah, it's pretty amazing. You find these clay tablets, and they're basically recording the earliest forms of futures contracts. It wasn't, high-frequency trading or anything. It was really sophisticated risk management for its time, all about reducing uncertainty.
Okay, paint us a picture. What did that actually look like back then?
Okay, imagine you've got these Sumerian grain farmers. Let's call them Pisha and Namran Shurur. They're planting barley, but they're worried, what if the price tanks by harvest? Now you've got someone else, maybe a priestess named Iltani. She needs a guaranteed supply of barley later, but she's worried the price might spike if there's a drought or something.
Ah, I see where this is going.
Yes, exactly. So they make a deal now. A futures contract written on clay. They lock in the price and the amount for later. The farmers get protection from a price collapse. Iltani gets protection from a price surge. That simple contract is basically insurance against the future.
Ancient insurance.
Okay, fast forward quite a bit. You can't really get to modern quants without probability theory.
Yeah.
So now we're leaping ahead, right? 16th, 17th century Europe, big names like Cardano, Pascal, Fermat. And they were less worried about grain, more about dice.
Yeah, gambling was the big driver initially. They were the ones who started to really codify the mathematics of chance. Pascal and Fermat, they famously corresponded about problems posed by gamblers, like this guy, Chevalier de Marais. He had questions about dice games, and they figured it out. They calculated, for example, that your odds of rolling a 6 within 4 throws are actually slightly better than even 51.77%. They turned gut feelings about odds into hard math.
Okay, so the math of chance gets sorted out. How does it finally connect with finance? That happens around 1900. This French mathematician, Louis Bachelier, writes his dissertation, A Theory of Speculation. And this is a huge aha moment.
Right, Bachelier. He's the one who first suggested treating markets like, what, an enormous game of chance? He came up with the random walk idea.
Exactly. His core idea was, well, simple, but really radical for the time. He said, look, all the information out there, it's already baked into the stock price. So at any given moment, the chance of the price ticking up or ticking down is basically 50-50. Today's move has nothing to do with yesterday's move. It's random.
And here's the really mind-blowing part. Historically speaking, Bachelier mathematically describes this random walk 5 years before Einstein published his famous work on Brownian motion, the random jiggling of particles.
It's incredible timing. Finance theory got there first, in a way.
It wasn't until later that economists like Paul Samuelson picked up on Bachelier's work again, right?
That's right. Samuelson was really influential. And interestingly, he himself was influenced by mathematical
Oh,
physics.
yeah. How so?
He was drawn to Gibbsian thermodynamics, which uses statistical mechanics to explain how things like heat distribute in complex systems. Samuelson saw the elegance in applying those kinds of statistical physics models to economics. It pushed finance towards mathematical rigor, away from just, telling stories about why things happen. Okay, so Bachelier gave us the random walk foundation, but his original model, it assumed that the actual stock prices followed that classic bell curve, the normal distribution. Real-world data didn't quite fit that neatly, though. It needed some tweaking.
So next up is M.F.M. Osborne, right? An astrophysicist jumping into finance in the 1950s. If Bachelier gave us randomness, what was Osborne's big improvement?
Osborne had a key insight. He realized that investors don't really think in absolute dollar changes. Like a stock going from $100 to $101 isn't the same psychological impact as it going from $10 to $11, even though both are a $1 change. What really matters, psychologically and mathematically, is the percentage change.
Ah, okay.
Right.
So it wasn't the price itself that followed a normal distribution. It was the rate of return, the percentage gain or loss.
Exactly. That's the modern version of the random walk we use today. Prices follow a log normal distribution. And Osborne even connected this to psychology, the Weber-Fechner law, which basically says our perception of change is relative.
Wow. So he was bringing in ideas from completely different fields.
Totally. He approached finance with the same rigor he used in physics. I mean, get this. This is a guy who apparently argued with Einstein in letters about the density of dark matter. He wasn't easily intimidated by, established authority, whether in physics or finance. He just followed the data.
Okay, but even these refined models, Bacheliers and Osbornes, they still relied heavily on that normal distribution, the bell curve. And that curve has a big problem, right? It assumes extreme events, like huge market crashes, are incredibly rare, like ridiculously rare. But them happen much more often than that. Was Wall Street just kind of hoping for the best?
You pretty much nailed it. And that's exactly where Benoît Mandelbrot comes in, the father of fractal geometry. He basically dropped a bombshell on the whole field. He showed that markets don't exhibit mild randomness like the bell curve suggests. They suffer from what he called wild randomness.
Wild randomness. Okay, what does that mean practically? He looked at things like cotton prices over long periods, right?
Yeah, decades of data. And he found they didn't follow the normal distribution at all. They followed something called Levy-stable distributions. The key feature, they have much, much fatter tails.
Fat tails, meaning extreme events are way more likely than the standard models predicted.
Vastly more likely. Think about it like this. The normal distribution might say a 10% drop in a single day is a once-in-a-million-years event. The fat-tailed distributions Mandelbrot found say, nope, that kind of thing happens way more often.
Okay, give us that firing squad analogy again. That really drives it home.
Right. So imagine trying to find the average landing spot for bullets fired by a bunch of slightly tipsy vacationers at a target range. It's messy, but the average location is pretty stable, predictable. That's like the normal distribution. Now imagine a drunken firing squad. Most shots land near the target, but because of the fat tails in that distribution, it's called a Kachi distribution, one type of Levy stable, one or two shots might go incredibly wild, landing miles away. Those extreme outliers completely destabilize the average. You can't reliably predict where the average shot will land because one wild one throws everything off. That's like the market, according to Mandelbrot.
Whoa. Okay, so the implication is terrifying. The very tools Wall Street was using to manage risk were fundamentally underestimating the real risk because they were ignoring the possibility of those wild shots.
Precisely. Mandelbrot showed that the comfortable, predictable world of the bell curve just didn't apply to financial markets. Extreme events weren't anomalies, they were an inherent feature of the system. And that realization paved the way for the quants.
Okay, so we've got the random walk idea. Osborne refines it to log normal returns. Then Mandelbrot hits everyone with the fat tails, the wild randomness. How do you actually turn all this like abstract math and theory into actual, cold, hard profit?
Right. Now we need to talk about the people who figured out how to actually use this scientific edge. Enter Ed Thorp.
Ah, the card-counting legend. But he was more than that, right? A mathematician, physicist. He basically invented the modern quant hedge fund.
Pretty much. Thorp's genius was taking insights from information theory pioneered by Claude Shannon, another giant, and applying them relentlessly to find an edge. His famous start, was beating the casinos at blackjack. He realized the hands weren't truly independent events like everyone assumed. If lots of small cards came out, the deck became richer in high cards, shifting the odds. That's card counting.
But it wasn't just counting, was it? There was something about managing the bets. The Kelly criterion?
Absolutely crucial. Just knowing you have an edge isn't enough. You need to know how much to bet. The Kelly criterion is a mathematical formula that tells you the optimal fraction of your capital to wager on each bet, giving your edge.
Okay, break that down simply. How does Kelly turn gambling into, well, something more like engineering?
It's all about maximizing long-term growth while minimizing the risk of ruin going broke. If your calculated edge is small, Kelly tells you to bet small. If your edge is big, you bet bigger, but never so much that a bad run of luck could wipe you out completely. It takes the emotion, the guesswork, out of position sizing. It's pure mathematical risk management.
And then he took that exact same thinking, find an edge, manage the risk mathematically straight to Wall Street, specifically with warrants.
Yeah, warrants are basically long-term options to buy a stock. Thorp realized that figuring out the fair price for a warrant was mathematically similar to calculating the true odds in blackjack or even a horse race. If he could calculate a true price that was different from the market price, he had an edge. Combine that edge with the Kelly system for betting size, and bingo, you have a systematic, repeatable way to beat the market.
Okay, so Thorpe is doing this almost intuitively using his math skills. But this quantitative approach really hit the big time with options pricing, right? Black Scholes.
Exactly. Fischer Black, trained as a physicist, interestingly, and Myron Scholes, developed the Black-Scholes formula. It became the industry standard. What they did essentially was provide a formal mathematical way to calculate the fair price of a standard European option. Turns out, it was mathematically equivalent to what Thorp had already been doing with his own computer models, but Black-Scholes published it formally.
And the really revolutionary part wasn't just the formula itself, but what it allowed banks to do, this idea of delta hedging. Creating a risk-free portfolio sounds almost too good to be true.
Well, theoretically, risk-free is the key term, but yeah, conceptually, delta hedging was the breakthrough. The Black-Scholes formula doesn't just give you the price. It tells you exactly how sensitive that option price is to small changes in the underlying stock price. That sensitivity is called delta. So if you sell an option, you take on risk. But the formula tells you precisely how many shares of the underlying stock to buy or sell short to perfectly offset that risk, at least for small price movements.
So, like, if the stock ticks up and your option loses a bit of value, your stock position gains the exact same amount.
That's the idea. You have to constantly adjust your hedge, rebalance your stock position as the price moves and time passes.
Yeah.
But if you do it right, theoretically, you lock in a small risk-free profit from the difference between the option's theoretical price and its market price, or just from the bid-ask spread. And that turned options from something exotic and risky into a standardized financial product that investment banks could manufacture, price, and sell on an industrial scale.
Yeah.
It made quantitative finance absolutely essential. But even Black-Scholes, as revolutionary as it was, wasn't the final word. Remember Mandelbrot and the Fat Tails? Black-Scholes still relied on assumptions like normal distributions and constant volatility, which we know aren't quite right. So the quants kept pushing, importing ideas from even more advanced physics like chaos theory.
Right, which brings us to the Prediction Company. Started in Santa Fe in 1991, these guys were actual chaos theorists, joined Farmer and Norman Packard. Their angle was finding local patterns, short-term stuff.
Exactly. They weren't trying to predict the market months in advance. They were using tools originally designed to understand things like turbulent fluid flow, whirlpools, weather patterns, complex nonlinear systems.
How does predicting turbulence relate to stocks?
They believe that even in mostly random markets, there are brief periods, small windows of time, where patterns emerge like little eddies in a stream. They called these transient attractors. Their goal was to build models that could spot these fleeting moments of predictability, these pockets of order appearing at the edge of chaos, and exploit them before they dissolve back into randomness.
And their trading wasn't based on just one magic model.
No, that's the engineering mindset again. They used ensembles of models. Think of it like multiple weather forecasts. They'd have several different algorithms, maybe based on slightly different assumptions or data inputs, all trying to predict the near-term direction. These models would essentially vote on a trade. If enough models agreed, say 8 out of 10 predicted an upward move, they'd take the trade. If the models disagreed, they'd stay out. It was about building robust strategies, not relying on one fragile prediction.
Okay, so that's the local short-term prediction. Then you have Didier Sornette, the geophysicist. His approach was way more dramatic, right? Predicting crashes.
Yeah, Sornette took a global view. He looked at market crashes not just as random bad luck, but as critical events, similar to earthquakes or materials rupturing under stress like a Kevlar tank failing.
How does an earthquake model apply to a stock market crash?
Sornette argued that crashes are often preceded by a period of growing instability within the market itself, often driven by herding behavior, everyone piling into the same trades. He believed this growing instability manifests as specific mathematical patterns, accelerating oscillations that follow a log periodic power law. Think of them as market tremors that get faster and faster right before the big quake, the crash.
Wow. And he actually found these patterns historically, like in the tulip mania.
Exactly. He argued that many historical bubbles, including the famous 17th century Dutch tulip mania where, yeah, people paid more for a single bulb than for a house, showed these accelerating log periodic signals leading up to the final collapse. He even used this model reportedly to predict the timing of the October 1997 mini-crash and the peak and subsequent crash of the dot-com bubble around 2000.
So his idea is that crashes aren't totally unpredictable bolts from the blue. They have precursors, mathematical warning signs, if you know how to look for them.
That's the core idea. Monitoring the market for these specific accelerating tremors could, in theory, give you a probabilistic forecast of when the system is approaching a critical breaking point. Hashtag tag outro. When you look back, the whole history of the quants is really this iterative process, just like science. Bachelier comes up with the basic random walk. It works, sort of, but doesn't quite fit the data. So Osborne refines it, log normal returns, not prices. Better, but then Mandelbrot points out the huge flaw. The model ignores wild randomness, the fat tails.
Right, it underestimates the real risk.
Exactly. Which then opens the door for people like Farmer and Packard at the prediction company, using chaos theory for short-term prediction, and Sornette, using critical phenomena models for crash prediction. Each step builds on and corrects the last.
So the real strength of the quants isn't some magic formula, it's the methodology itself, right? The physics approach. Make assumptions, build a model, solve it mathematically.
And then immediately, rigorously test where it breaks down. Where do the assumptions fail? How can we make the next model better? That's the key.
Firms like Renaissance, they succeeded because they never stopped questioning their own models. They embraced that constant cycle of building, testing, breaking, and improving. It's engineering.
Absolutely. Mathematical sophistication wasn't the problem. It was the tool needed to grapple with a really complex system.
It's the relentless search for flaws that gives them the edge, not pretending the model is perfect.
It forces a kind of humility, actually. Perpetual refinement.
Yeah.
Science.
Okay, so that leaves us with a really interesting final thought for you, the listener, to chew on. We know these predictive models, when they work, make huge profits for the people who have them. But think about Sornette's crash prediction model, the earthquake detector for markets. What happens if everyone starts using it? If all the big banks and funds are watching for those same log periodic tremors, those signs of instability?
Yeah. If everyone sees the earthquake coming?
Right. Would their collective action, maybe selling preemptively, actually prevent the crash from happening? Would the model, by becoming widely known, effectively cancel itself out?
It's a fascinating feedback loop.
It really highlights this constant cat-and-mouse game between prediction and market efficiency. The moment a successful model becomes common knowledge, it might change the very market behavior it was designed to predict, forcing the quants back to the drawing board once again.